my immediate right is Peter Alderman, who is with Golden Tree Capital in New York. He focuses on fixed income. He is general counsel as well, with legal responsibility for the distressed investing and restructuring group. And prior to going to Golden Tree, he was a senior associate at Debevoise and Plymouth. Next on his right is Pat Nash from Kirkland and Ellis, one of my former partners at another law firm, currently representing Hawker Beechcraft, many other debtor representations. But I'm going to list some of the ones that may be more important for today. Is the distressed investors and distressed purchasers he's represented, and it's sort of a prelude to all the places we'll see our hedge funds and private equity. He's represented the ad hoc committee of senior secured lenders in Constar, the ad hoc committee of note holders in TerraStar, Angelo Gordon in Jason Inc., Sun Capital in various acquisitions, and ad hoc lenders in Vitro US and Arch Aluminum. And then finally to his right, with no name tag, is a stand-in for today, but actually we apologize to Ken. Those of you who know Ken came in when Gary Holzer had a partner meeting, and Ken, I think, will be more lively than Gary, and you can tell Gary has said that. Ken leads the bankruptcy, financial, and reorganization creditors' rights groups at Lowenstein Sandler, one of the top unsecured creditors lawyers in the country, numerous high-profile committee matters, and occasionally dabbles on the debtor side. Today's panel is about the role of hedge funds in corporate restructuring and white knight versus villain. For those of you, just talk a little bit quickly about white knights and villains. If you go look at, online, white knights are those people that saved the damsel in distress. And for those of you old enough to remember the corporate takeover days, they were the people that came in when the company didn't want to sell in a hostile to somebody, to take the control of the company and save the company, although there was always a change of control, and I think we're all familiar with what villains are. So in that context, we're asking the question today, what's the criteria for judging whether the hedge funds or private equity funds are white knights or villains? And I'm sure we'll come up with an answer that there's somewhat a little bit of both, unless Ken speaks up. But when I ask the question, I'll sort of turn to the panel. How do you judge what's a white knight or what's a villain in the restructuring? And we put out some questions. Peter, just your thoughts about how should we be judging the question, are hedge funds or private equity funds, and then we'll talk a little bit about the distinction, are they white knights or villains? How would you see that question phrased?
Sure, thank you, Gregg. And I think that, to be honest, there are a number of ways to look at it. The sort of simplest way to look at it, I think, is from the perspective of the debtor as an ongoing enterprise. Is a hedge fund, as a private equity player, more or less likely to keep that ongoing enterprise, to allow that ongoing enterprise to survive a restructuring and reorganization process, either in or outside of bankruptcy? I think there are also other ways to look at it as a white knight with respect to the actual process of a bankruptcy. Are hedge funds, private equity players going to facilitate the bankruptcy process? Are they going to make it a quicker process, or are they going to push it into lengthier deliberations through holdouts, through a value destructive process that might last years and might increase the likelihood of a liquidation? And so I think actually liquidation really is sort of the opposite. It's the poor result I think we would generally want to avoid. I think you ask most people in this country, is liquidation a good thing or a bad thing? It would be a bad thing. That would be the villainous side of hedge fund and private equity involvement. Although, as we'll discuss now, as I will argue, I think an outcome that the involvement of hedge funds and also private equity players reduces the likelihood of.
So we already got this set up with Peter saying they're going to be on the good side. So let's turn to Ken. Ken, how would you, before we started the panel, I asked you, are they white knights or villain? How would you want to analyze the question?
I guess I'd want to look at the question of whether they make true reorganizations and restructurings more likely or less likely. I think today we're seeing Chapter 11s that are nothing more than 363 sales, prearranged or pre-packed debt for equity swaps. I think the number of true old-fashioned reorganizations that are done, have plummeted. which means that the opportunity for trade creditors, to receive a dividend in cases has plummeted. So to me, the question is whether the impact of private equity and hedge funds is making traditional reorganizations less likely. And you also have to take a look at who the players are in bankruptcy cases today. When I started out practicing law, the biggest threat to a lender, to an institutional lender, was that you let them win. When they pound on the table and scream that they're going to seek stay relief, you knew darn well that's the last thing they really want. Now we have different players at the table. We have players at the table who aren't afraid to take back the collateral or to convert debt for equity. So I think the question is it making reorganizations and restructurings more likely, or is it making just a 363 sale and turning over the equity inevitable?
Pat, go ahead. You're now.
So, listening to Ken, I can totally understand where he's coming from as a guy that represents a lot of companies and does a lot of debtor work. There's this feeling that the hedge funds are the bad guys. But, in reality, in all these cases where we're talking about the hedge funds and when they're leaning on the company, when they're leaning on people like me, the reality is that there's probably not a lot of liquidity, and there's probably this hedge fund. At the end of the day, liquidity is king, right? Who's got the money? So these companies, and what I'm finding more and more is these hedge funds are pretty sophisticated. They lived through, people like Peter and his colleagues, they lived through the boom like late 90s, early 2000. They've seen the movie, and they're not going to see it, they don't want to see the sequel. So they lean on us, and they are tough to deal with. But, usually, look, if you can get money from Wells Fargo or GE, you're going to get money from Wells Fargo or GE or JP Morgan. If you're talking a hedge fund X, Y, or Z, usually that's the only source of financing for the company. And at the end of the day, I think in all these situations, like when Ken talks about, and I understand why he does as a guy that represents companies, but fair or it's not fair or we want procedures. At the end of the day, the hedge funds are in these circumstances where we're dealing with them and when we're tolerating people like Peter, it's because they're the only source of financing in the room. And if they're the only source of financing in the room, then obviously they're going to play a big role in these cases.
Yeah, and then we'll go to Peter. When we look at the questions, so on the slide, so the first thing that Ken's raised is, are more companies over leveraged by private equity or hedge funds? Do they file bankruptcy more frequently? Are they sold in 363? Do they liquidate more often, or do they reorganize? Ken's words were, we don't have there's nothing more than pre-packs and pre-arranged or 363 sales. There's no more good old traditional company restructuring. The question I think people have to ask is, are those good old-fashioned restructurings that much better than an exchange offer, a pre-pack, a 363 sale, or is that just capitalism at its best? Now, Peter, you wanted to talk.
There are a couple of things, actually, just sort of furthering what Pat said. One thing we're seeing, too, when we sit down with a distressed company...
And we're only just tolerating it now.
Barely tolerated here. The big banks aren't at the table anymore. So it's not even a question of where a company is going to get its DIP loan from, where they're going to get post-reorg financing from. It's simply a question of who they're going to be talking to as they become distressed. The liquidity of the market is such that, to the extent that there were banks involved initially, traditional leverage loan practice from your Banks of America, your Citi, your Wells Fargo, they've already sold out, or it's been passed to their restructuring desk. But you're going to be at a table with a large number of hedge funds, occasionally mutual funds, some CLOs, CDOs, although those numbers have been reduced. And so you don't even have the opportunity to begin a dialogue in the same way with the traditional lenders. You're going to be sitting down at a table with, for better or for worse, the likes of the golden trees of the world, avenues, canyons, oak trees. And so I think that's where your source of financing is going to come, but that's also where the dialogue is going to occur about how the restructuring is going to proceed. And I think, and this perhaps goes to Ken's point too, because that's where the dialogue is taking place, I think there is going to be a determination really by those entities to try to move this along faster. to try to avoid value destruction that can occur in a lengthy bankruptcy, although it's really
Well, what's the impact of the fact that today, in terms of liquidity, bondholders, bank lenders can trade in and out of positions far more easily than they could have, let's say, 15 years ago, right?
I think there's an upside and a downside, clearly. I mean, the upside is you begin a restructuring process, you begin a dialogue with an ad hoc committee, and 3 months later, the members of that ad hoc committee are entirely different. And they purchase at a different price. They purchase perhaps at a price so low they're simply looking for liquidation value. It can be difficult to keep that dialogue going in the same way. And so I think that's a certain downside to it.
So I'm just curious, when you're representing a debtor, what's happening to you in the negotiations when you've got people across the table from you that bought, at par, some people who bought it, half on 50 cents on par, and isn't the motivation completely different? I mean, for someone who bought at 50 is scoring big if they get 75.
Yeah, but at the end of the day, though, for me, when I represent companies, I want optionality when it comes to financing. I want to be able to tell GE to go blank themselves. I want to be able to tell Wells. I want to have optionality. And people like Peter, people that are, you need financing. That's the end of the game. The day, you need financing in these cases.
Why don't we go to the next slide, and then we'll go back to that point. The traditional players were the lenders and the bondholders. They're secured or unsecured. They started out a case, usually with contractually set rates, risk of investment, defined terms, priority payments, levels of securities. Trade creditors, unsecured, exposure, agreed credit terms, debtors to which, and then the statute gave them 503b9, and you had your shareholders. So Ken, how have you seen in let's just say the last 5 or so years, how have trade creditors changed their perspective on the restructuring process, both before and in a case? And then I'm going to go back to Pat on how that affects the company's negotiations.
Well, first of all, there's a lot more information available to trade creditors today than before we were in what I'll call the digital era. 15 years ago, trade creditors had a very difficult time finding out what was going on in cases. They didn't know what price bonds were trading at. They couldn't figure out what price bank debt was trading at. They'd call up the debtor, try to get information about the debtor's financials. Absent an SEC filing, they were really in the dark. Today, a sophisticated trade creditor can go onto market, M-A-R-K-I-T, find out the price at which bank debt is trading and make a judgment based upon that. They can track on Bloomberg the price at which bonds are trading and make a judgment based upon that. So, trade creditors today have a much better ability to manage exposure very early on. And because, the bankruptcy profession loves gossip, anyone who subscribes to DebtWire or Bankruptcy Law 360 knows in 10 minutes, when one of their customers has hired a turnaround, management firm or a firm, like yours that does, a lot of debtor work. So there are no secrets like there used to be. So trade creditors, have the ability to manage, if they're paying attention, more akin to, institutional investors.
So let me ask you this. Do you get calls from trade creditors that you have a long-standing relationship? Oh, wow, Silver Point's in there, or Black Diamond is in there, or Cerberus made an investment, or Centerbridge made an investment. Has it changed the way that the creditors look pre-filing?
Absolutely. Because when we see a Silver Point, a Cerberus, a Fortress, whatever, we look at that and we say, okay, if this thing goes into a meltdown, restructuring, there's a much better chance that the institutional lender is going to say, all right, either this thing's got to be teed up for a 363 sale and you have 90 days in Chapter 11 to do it, or this thing is going to simply be sold in it'll be the subject of a pre-pack or pre-arranged case. And traditionally, the trade creditors are going to be dwarfed by the unsecured bondholder debt, and the typical case will do one of two things. Either there'll be a token dividend, 2 cents, for the unsecured trade creditors, or they'll ride through unaffected if the trade debt is very small. So from a trade creditor's perspective in the larger Chapter 11s today, they have to look at the identity of who the institutional lenders are and, project how they will respond in a reorganization. And given that lenders today are very different, as you just said, they're very different than they were 15 years ago. It's not the traditional ABL lenders that we're seeing who dominate the case. It's, bondholders, hedge funds, private equity shops who are dominating the cases. They're very happy to take back the collateral, to manage it, to rehabilitate it. And at least what I'm seeing is that they don't have the patience for a Chapter 11 that rebuilds value.
Well, but then Peter, why don't you, I'll let you respond. I'd be dying to. But, so Ken says, all right, private equity comes in, it's going to be quick, it's going to be a 363 sale, it's a small dividend. But compare that to what, or Pat, compare it to the traditional ABL lender, the GEs of the world. How many times have you had more conversations about a liquidation with a traditional lender versus a Golden Tree, a Centerbridge, even a Black Diamond? I'll leave either of you.
I'll tee this up for Peter. I'll tell you guys, we think about like the glory days or the golden days. Nothing is worse than when you're talking to GE or Wells and you have no leverage. My experience, and you're in formula. You got a borrowing base, and you're in formula, and you need like a simple amendment, and then they're large and in charge. So to me, if I can threaten people, there's nothing you can do without liquidity. But if I've got someone, a Silver Point, a Black Diamond, Wayzata, you name it, and they're willing to prime or they're willing to loan against unencumbered assets, or just so I can even threaten it, even if it's not real. Something other than, thank you, sir, can I have another? That is literally what we need.
How many times have you called up Cerberus about 5 days before a filing or 10 days before the filing, and they give you the term sheet, and it may be 18%, but you use that with the traditional lenders to avoid exactly that situation?
Absolutely. And you know what? If I call somebody like Peter, if I call Golden Tree or Black Diamond, they'll give you, by the way, they'll turn around, they'll give you a term sheet on unencumbered. Yeah, it's going to be expensive, but you got optionality there.
Yeah, no, we're often sort of sandwiched, I think, but we often find ourselves in a position of having the first lien secured debt, and so we're working with the ABL lenders. And that's one of the few areas that's still very much dominated by the traditional lenders, by GE, by
because you guys don't make revolving loans.
Yeah, it's very right. So we have some capacity, and some hedge funds have more capacity than us, but it's not a big business for hedge funds. It's difficult for us to do, difficult for us to manage inventory, look at the borrowing base. But yes, we find it very difficult to negotiate with the ABL lenders. They are absolutely expecting to be made whole. They're expecting extraordinary terms to grant extensions, to waive covenants. No, it's really of all the players we deal with, even sort of the toughest vulture funds, it's the old-fashioned ABL lenders.
The toughest vulture funds are at least usually taking risk, or they're financing a specific process. Nothing is more galling as a guy that represents companies than an in-the-money ABL lender where we're in formula and everything is a problem.
And most hedge funds aren't coming into a situation looking for a liquidation. I have not seen, and I can't imagine a situation where our fund or other funds I'm familiar with will go in and try to seek value through a liquidation. However, the ABL lenders are largely indifferent. If they've been managing their borrowing base and doing their job, they're significantly in the money.
And Ken, let me go to sort of that point. I know from my own practice where I've had liquidations, and I've had quite a number, unfortunately. The hedge funds and the private equity funds have not been involved. Have you had liquidations, real old-fashioned, sell everything, GOB sales? How often have hedge funds really had a significant role in those versus your traditional ABL lenders?
I think their goal, you're correct, the ABL lenders are typically much more comfortable with the liquidation.
So we can put them on the villain side? Everybody want to put the ABL lenders on the villain side today? All right.
I know I do.
You're correct. The hedge funds and the PE shops are going to push for a quick 363 as a going concern. They're going to push, for a debt for equity swap. But what I was going to say is, don't you really have to back up the clock? We're talking about the situation in Chapter 11. Let's talk about the situation that builds up to the Chapter 11, and the situation where money is so free, or close to free, that everybody and their uncle is just loading up on Journal about everybody's, loading up on bonds today in order to pay dividends, to cash out. There was an article last October in the, I think it was in the Times or the Journal, junk bonds are living up to their name again.
So thank God for that. But I mean, Peter, why don't you talk about that market? Then I'm going to ask you, okay, so what's so bad about people taking money when money is available to you?
I'm not saying it's bad to take money when money is available, but the question is it good or bad for the, for bankruptcy? Is it good or bad for the economy, for companies to lever themselves up to pay dividends, to lever themselves up, to do a sale? Aren't those the very problems that we're seeing in some of the Chapter 11s?
We'll take the rabbit out of the hat and ask whether there are problems in a second. But why don't you talk a little bit about the market, and then I'll ask Pat.
I mean, I think Ken's absolutely right. The market is quite simply incredibly hot for leveraged loan products, for high-yield bonds. I mean, in many ways, it's the perfect storm of factors that are going to drive these sales. I mean, there's the impending tax cliffs. You have the dividend recaps that Ken was talking about, where the private equity players are just trying to suck their cash out now and avoid the tax exposure. You have incredibly low rates. You have few investment alternatives. The equity markets, while they certainly have done reasonably well this year, just haven't attracted the same sort of capital. I think there's still a risk aversion there. And that sort of leads into this massive liquidity in debt and fixed income. I mean, in the past 6 months, there have been record inflows into ETFs, into mutual funds, into hedge funds in the fixed income area, both for leveraged loans and for high yield bonds. And in fact, those have continued only the past couple of weeks as more money begun to come out of the high yield bond market, but leveraged loan market continues to boom. And I think with that incredible liquidity, you were seeing a reversion to sort of the high points of 2006, 2007. I mean, we're seeing yield compression. We're seeing cov-lite loans. We're seeing leverage ratios that we don't like to see. In short, there's a lot of issuance out there, a lot of product on the market that hedge funds would like not to buy. Unfortunately, that said, there's also a massive community of hedge funds with significant money to spend, and they don't make money by not spending it. And because of competition in the marketplace, they compete with each other, further driving down yields, further allowing borrowers to borrow cov-lite, to over-lever. And so I think we are seeing, depending on your perspective, fortunate or unfortunate culmination of events is going to lead to greater over-leverage or perhaps inappropriate leverage of companies that are going to be unable to support it in the longer term. I say fortunate, unfortunate, because I think most of the folks in this room could benefit significantly from this in the years to come. But I think on the white knight villain side, this massive growth of liquidity, the easy terms, the nearly free money, it probably falls more on the villainy side.
Pat, with respect to the company side, I know I've been on it, but okay, so you have a market out there, there's lots of liquidity. I'm an owner of a business, I'm a shareholder. Let's take private or public, and I built this company. Is this bad if there's all this money out there, and what am I going to do?
I mean, it's definitely obviously not bad. I mean, and what's the problem with, dividend recaps, and what's the problem with people taking money out of companies? I mean, at the end of the day, I keep coming back to there's nothing worse in life when you represent a company than when you have to deal with GE or Wells and you have no leverage.
So, and with respect to capital, I don't know how many times I've represented a person that's still doing it now that's built a business. They borrow it at 16 or 18% when everybody was tight. Now they can borrow at 3, 4, 5%, pay them down. What's wrong with that? Is there something illegal, immoral about that, Ken? Even if I take all this debt, can pay it, and I believe my business is going to turn around, and some have turned around. Aren't I trying to stay out of restructuring? Isn't that what we're supposed to do?
Look, I don't have a problem with borrowing. I think it's a matter of degree. The problem that I guess I view it as a problem, but the problem that I see is money is so cheap that companies are simply, they're intoxicated on the borrowing. In yesterday's article, it said Moody's Investor Service downgraded 27% of companies that issued bonds to pay dividends in the last quarter so far of 2012. So what does that mean? If 27% have been
you read that,
downgraded, doesn't that mean that these companies are suffering a decline in credit rating because they're overborrowing? How's that a good thing?
But I actually think this exposes sort of the big difference between hedge funds and private equity funds. And we've sort of, I think, lumped them together in our discussion so far, but in fact, they're antithetical in this situation. I mean, hedge funds are almost entirely on the lending side, and there's obviously crossover.
Why don't you, what's your understanding, because I've used the phrase hedge funds and private equity, why don't you sort of describe what you see as the difference between those two things?
I mean, the main difference is simply, as the name implies for private equity, they're on the equity side. They put the money in on the equity side. They borrow money. The companies they're purchasing go to the market, they issue high-yield bonds, leverage loans. Those products are bought by hedge funds. So almost invariably, the situations we find ourselves in, we're on the creditor side of the table across from private equity funds on the debtor side of the table. And I think for the private equity side, there's every benefit to be gained by the dividend recap. You put your money in. If you can get that money out early on, anything else is gravy. So in other words, they've made their return if they can get a significant dividend recap early on. And then they have less concern later about both the operations of the company and the ultimate outcome of a disposition. So we are very concerned as lenders on the other side when we see the dividend recaps. We're concerned that the company is simply becoming too thinly equitized, and it exposes your second lien loans to significantly more risk.
Is that really true that if the private equity shop has pulled out their dividends and recovered a big portion of their investment, that they ultimately care less about the operations of the company?
Of course, they're trying to maximize value. And so I think the answer is it shouldn't be. I think there are a number of factors that are going to go into that. First of all, it's going to be how good a private equity shop they are and how good the individuals there are at managing it. I mean, it might be simply a bandwidth issue. They've hit a home run with a large dividend, massive valuation increase, big dividend recap, and the folks, the portfolio managers there, are focused on other matters. It may simply be also that the private equity fund is coming to the end of their investment period. And this is another key difference, I think, between the private equity world and the hedge fund world. Private equity funds have an investment period. They have 6 years, 8 years, maybe with extensions they can get up to 10 years, but then they're really forced to make a sale. And so if they're taking their dividend recap towards the end of that time period, they're going to be looking to make a sale really at any price, especially if they're already up by the end of their investment period. Or at least, by the end of their wind down period, a couple of years following their investment period. And they can get extensions, but it's difficult, and they like to get the cash back to their investors. So I think where you are in the private equity cycle is important. And are you also with a large enough private equity sponsor that they have other funds who will take up and buy out the original fund and keep the investment going? Those are all sort of myriad complexities that play into negotiations that are very difficult for the lender market to really have clarity into, and I imagine also very difficult for the portfolio company as well to fully appreciate. Hedge funds, on the other hand, are open-ended. I mean, they face the problem of quarterly, semi-annual, or annual liquidity where investors can get their money back, so it's somewhat difficult for the hedge fund players to make a long-term equity investment. And I think a lot of borrowers are very concerned when they see hedge funds come in a recapitalization, end up with a significant amount of the equity because they're worried they're going to be forced into a liquidation when that hedge fund is forced into a liquidation. I think, though, in reality, and I think oddly enough, 2008, 2009 really proved this, the larger hedge funds, the hedge funds who are significant players in this area, the Silver Points, the Avenues, the Canyons, they weathered even really a horrendous time and continue doing what they do. And so I think the fear that borrowers have faced, that they're going to be sort of subject to the whims and whimsies of investor liquidity demand into the hedge funds is ill-placed. It just hasn't been borne out, although of course it theoretically remains possible.
And what about access to new management? Is there a distinction? Some funds I know have what I'll call a stable of executives that they can parachute in. Some don't have that. What have you found there?
To be perfectly blunt, I mean, the traditional private equity players are much stronger in this area. I sort of think what makes a private equity player is the size of their Rolodex. It's when they buy the portfolio company, is how many people they can call upon immediately, both to come in as management, to come in as advisors, other portfolio companies to work together to create synergies across our portfolio companies. That's what private equity players traditionally do, and the best of them are very good at that. I mean, the Blackstones and KKRs, that really can create significant value. For the most part, hedge funds are weaker in this area. I think, and because of that, in a way, the hedge fund focus is a little different. I think a lot of the hedge funds, ourselves included, when we look for opportunities in the distressed world, are looking for companies that actually are fundamentally sound, that may have some management problems, but aren't a management disaster. What we're really looking for are companies that have capital issues. They were simply over-leveraged. And if their capital structure could be fixed, they should be able to be ongoing successes without too much tinkering. So I think there's still a very strong place for traditional private equity players to come into the truly distressed entities that need significant work, significant turnaround work.
So Ken, when I hear this, I don't understand why I represent, and I know Pat does, when you represent a company and you have equity people, the shareholders, right? That can be a threat to the shareholders because there's oftentimes a difference in value. But I don't understand how it's a threat to trade creditors. How having this money, this liquidity, even at the rates, how that actually threatens the trade creditor.
Because the more, I mean, let's say you're a trade creditor selling to, XYZ company. On day one, you're selling to a company that's not over-leveraged, that doesn't have an overabundance of debt on its books. On day two, after they've borrowed, $500 million to pay dividends, the trade creditor looks at the situation and says, okay, the private equity's cashed out, but I now have a much more leveraged customer that I have to worry about. And if there's a hiccup or a burp in the market, the first half of 2013, am I going to end up as a creditor in a Chapter 11 because they borrowed $500 million to pay dividends, before the tax laws changed? So we look at the situation and we say, okay, we now have a much more risky customer because equity has cashed their chips in. So how could that be good?
Well, Pat, do you feel much sympathy for that?
I don't. But because look, at the end of the day, these hedge funds are there with money, okay, and they're providing liquidity to companies and they're providing optionality. And yeah, they want to own the company quickly, and they're bad guys, but they're usually pretty smart. And I, as I said earlier, I think they've lived through the earlier cycle, and they're not very tolerant to professional fees, and they're and these trade creditors These trade creditors don't know when companies take a dividend, okay?
Well, but if they do, one of Ken's points was there's so much more information out there. Well, if there's so much more information, then don't do business with the companies if you don't like it.
Right. Doesn't it make a difference whether someone or some entity is borrowing money to build a new factory that will create all kinds of better economics for the company, or borrowing money to make an acquisition that will create all kinds of synergies, as opposed to the company that's borrowing $500 million in the bond market to cash out, its shareholders or to make a special dividend?
God forbid.
Why do you? Well, you've asked me the question. Is that rhetorical or what's the question?
But it's like glory days or something. It's a problem. These people, and I know, but so they're borrowing money to pay shareholders. That's what we do in this country. I would hope.
I think at the end of the day, it's simply a question of capital allocation. This is perhaps less a bankruptcy question, a topic for this panel. But I think the very best of companies out there will allocate their capital most efficiently. And so in the perfect world, you'd only have the dividend recaps if there weren't other more profitable uses of that money. But on the other hand, if there was a more profitable way for a company to allocate its capital to build a factory, that's of course what a company should be doing.
Or these private equity funds, so they take a dividend out of this company to go buy another company. At the end of the day, I think when you overthink, why they're doing what they're doing, who's anyone in this room or anyone on this panel to tell some hedge fund, oh, you shouldn't do this or you should do that. At the end of the day, to the extent that they're making investments, we're all going to be better off in the long run.
So,
Wait a minute, making investments, borrowing money to pay a dividend is not.
but I mean, Pat's point is, if you, right, it's not like they don't then, I mean, to Peter's point, if I borrow money to pay a dividend, it goes back to the private equity fund. The private equity fund doesn't make money by sitting on that dividend, it's got to reinvest it in a company, right? I hate to say it, but isn't that capitalism?
I guess it is. I guess it is capitalism, but the alternative is that they don't take out the dividend, to the same degree, and the money stays in the company, and they use internal funds to grow the business rather than borrowed funds that over leverage the business.
Well, but let's now talk a little bit about that, right? So I've got on the slide now that, one of the things that we're seeing about private equity and hedge funds is they're all over the capital structure. And one of the concerns, you seem to say, well, they can be the DIP, they can be the second lien lender, they can be the exit, they can be
And
the
they could be all of them in some cases.
And a lot of times they're all of those things, right? And they're purchasing existing loans, they do participations. But again, I'll say, what's wrong with providing liquidity to overly optimistic owners, poorly performing businesses, purchasing undervalued debt, or helping those tired and deal fatigued lenders from exiting? What's wrong with those things?
I don't have a problem with borrowing money to exit, an secured creditor. I do have a problem with borrowing money for the first two things that you talked about, poorly performing business and stuff like that.
Why? Why? If I'm a lender, if I'm an owner, right, I'm always optimistic. Who's to blame? The hedge fund that lends or the owner that takes?
Didn't we have a mortgage crisis about this?
Guess that's my question, Ken. You seem to, who's to blame here? Is it the owner that lends?
By the way, one of us is supposed to be like helping Ken.
Oh, who's gonna help? All right. I'm accustomed to this. Come on, that's why you put it on the moderator. So go ahead. So Peter, what is there anything wrong? I mean, when you go and make your investment decisions, what do you actually look for in the businesses?
Well, and I think this is sort of a broader question. Hedge funds are all over the map. There are hedge funds that will never hold a position for more than 24 hours, or probably more than 2. And so they're looking for just immediate irregularities in the market, just a slight tweak of information, a moment's timing. And so they're trading in and out. They're providing a lot of sort of the buffer liquidity, but I don't think they're the folks we're necessarily talking about. The folks who can come into companies in a distressed situation are, for the most part, longer-term investors. Because I think the risks are such, especially as you get into a distressed scenario, and the expertise required to understand the bankruptcy process, that it's a type of investor that has to really done a fair amount of research before they're going to take the risk. And if they put that investment into it, they're going to stick with the position for a while. And so I think you have a sort of, often, and this is sort of the liquidity I was discussing earlier, you have a reshuffling of the chairs as a company gets distressed, and the exit of not only the institutional players, the larger banks, but you're also having an exit of the short-term traders who are going to, I think, be a little more frightened at the signs of imminent distress. And you're going to have the entrance of a large number of funds that are really not focusing in this area. I mean, the silver planes, the black diamonds. But I think you'd be amazed by the dozens and dozens of funds that in recent years, especially since 2008, have raised distress funds specifically focusing just in this area. I have to admit, I've drifted away from the question significantly.
And I forgot the question.
So Greg, one thing I will say though, to me, will the hedge fund get restricted? That's a big deal.
Right.
I don't
talk a little bit, Pat. I mean, because I know that in my practice, you spend most of the time negotiating, one, whether they restricted, the cleansing provisions, and how that affects the negotiations.
Well, to me, anybody who's in the capital structure who's willing to get restricted is a player and should be respected and is very important in the process. And if you're not willing to get restricted and you want to be a trader, this is where you get into, like, are we talking, Peter, about, a trading shop or a distressed M&A shop or a distressed private equity shop? Because, maybe Peter, you could talk a little bit about what you guys go through at your firm in terms of the decision, because it's a big one for these guys. Do I get restricted or not? But for me, as someone who represents companies, If somebody's in the capital structure and they're willing to get restricted, and they're willing to take material non-public information, and they want to participate in the solution, that's obviously, from my perspective, a very positive thing.
Player in this, or are we going to ride it out and see how it goes? And if we're going to be a big player, if we're going to buy, either have an initial position that's large or buy up to a significant position, we're absolutely going to want to be restricted. There's no way we would have a 20 or 30% stake in the first lien debt of a company that's going through a restructuring and not want a seat at that table. The risk is simply too large. And so often we'll sell pretty early on, but not always. I mean, there's also the hold-up value. And you can get your 3, 4, 5% position and really just wait it out, watching where the trades are and trying to time it right, or wait until the end, or especially if you're working, if the goal is to get an out-of-court restructuring where your hold-up value is going to be significant. And I think for many deals, the out-of-court restructuring really is the goal. And so there is a sort of this end game of holdouts. You can also have it obviously in the in-court process as well, but the threshold is significantly higher in terms of the stake you need. So I think the decision you have to make early on, and then there is a tension usually it's between funds, between asset managers, between those who are restricted, those who are trying to get something done, and between those who everyone knows are not going to be in it at the end of the day. And it's simply trying to get them to sell for a price that works, or threatening them with ground down.
So I'm going to go now to sort of what I'll call the situational analysis. Role of hedge funds and private equity funds, helpful or hurtful to out-of-court restructurings? Anybody want to start a view?
I'm probably not the right one to talk about the out-of-court, because trade creditors are usually not involved in that process, but when you get to the in-court, I'll have some comments.
All right, Pat, what do you think?
Again, I mean, I think anybody that wants to write a check or be part of the financial solution, and of course they're going to be a pain in the ass to deal with, but if they're there and they're restricted and they've got a role to play, I think that's helpful.
Yeah, and I think I said it before, but I think hedge funds are very important in pushing out-of-court restructurings because I think it avoids the uncertainty of bankruptcy, and uncertainty is the biggest concern of any asset manager.
So now, I'll add my view is that because of their flexibility, if you can get over the restrictions, you can get to the negotiations, and you get to the view of value. Now, Ken, you may say they've gotten them over leveraged to be in this position in the first place. Nonetheless, the only out-of-court restructurings that I know of, usually it's those kind of funds, not the lenders, that are prepared to do the exchange offers or any sort of recapitalization or conversion of some debt to equity. So on that side, I would probably give them they actually facilitate as
Look, I think an out-of-court restructuring, among the institutional debt holders is great. It avoids a Chapter 11, doesn't get involved with the whole process of unsecured bondholders, competing against a minority of trade creditors. I mean, we always love to see the out-of-courts.
Okay, so now let's go to the second type of, what about with pre-packs and pre-negotiated? Where do people come out on private equity funds and hedge funds and their role there? Facilitator or obstructor?
You don't have a pre-pack or a pre-arranged deal without hedge funds. I mean, by definition, you need somebody to talk to. And so, again, as someone who represents companies, and I deal with people like Peter all the time, and yes, it's irritating and it's frustrating, but if they've got capital, then you have options. And you hear me keep coming back to this. There's, for all the hedge funds, there's nothing more irritating and more frustrating than talking to an in-formula revolving lender who's a pain in the ass.
Who's increasing the discretionary blocks on your accounts?
Yeah, absolutely, right.
Yeah, but the real question is, once you're in a Chapter 11, whether it's a pre-pack, pre-arranged case, or even a free-fall, okay? What we're seeing today is that the trade creditors have a minority position on the committee. Compared to the total unsecured debt in the case, they're a real minority. And when the creditors committees are formed, typically the bondholders will often dwarf the number of members on the committee who are traditional trade creditors. And if it's a pre-pack or a pre-arranged case, the creditors committee, if it's if it's trade dominated, is in the position of being able to do no more than trying to get the dividend from, a penny or two to 3 or 4 cents. Because the case is on a fast track. Judges, I don't think, are real keen on derailing pre-packs or prearranged cases. Job preservation is more important than almost anything today. So what we're seeing in the Chapter 11 world is whether it's pre-packs, prearranged, or free-fall Chapter 11s, the trade creditor plays a very minor role. And the creditors committee, once the case begins, is chasing the bus.
I guess let's break them down though. Pre-packs. Let's just start with pre-packs. What normally happens to trade in a pre-pack?
Rides through.
Rides through. So what's the complaint?
And these trade creditors, there's an official committee, so they have a voice, but at the end of the day, they just want the company to survive.
We're going to go to Ken on his picket. Do you want the dividend or do you want a customer? But we'll get to that when we get to traditional. But pre-packs, there's never been unless you are going to classify them separately, trade and unsecured creditors, ride through.
Right. And Virtus 22.
Well, but that's the failure of the ultimate debt on the company later. But take CIT, one of mine, right? Without the center bridges, the oak trees of the world, you wouldn't have financed it. Without them, you wouldn't have restructured it. And without them, you would have had no case. I'm sure Pat's got, now we'll talk about maybe pre-negotiated. Hawker, Pat, you've got funds there that backstopped. Why don't you talk about that a little bit?
Yeah, so take Hawker Beechcraft. In the first quarter of 2012, we were running out of money, and we literally picked up the phone and we called. Thank God for Hawker Beechcraft that of the $1.7 billion, secured debt, 4 funds held 70% of it. You can pick up the phone, you can call them. You can call Centerbridge, Angelo Gordon, Sankety, and Capri, and right away, they're there. You can meet them at the 50th floor of Kirkland and Ellis in New York, and they're going to protect their investment. And so, do they want terms? Of course they do. Do they want some say in the case? You bet your ass. But they're loaning a lot of money to the company.
Right, and they could and what they do? They actually backstop a plan. They let you look for a shop. They set a minimum price. And creditors that go forward, why don't you explain?
No, and it's so yes, and of course it's expensive financing, and everybody's got a problem with it. There's nothing more frustrating than when everybody agrees that the company needs financing, but you're still in court trying to get your DIP loan approved over the objection of somebody like Ken, who says, Judge, we need money, but not at this interest rate. Give me a break.
No, and I'll go back to sort of Ready Ice without them doing a pre-negotiated, the funds getting together. Trade creditors, you might have had a liquidation, you might have had a sale. Trade creditors essentially ride through.
Yeah, look,
we're going to pick on you again, Ken.
It's all right, I'm accustomed
Someone on this panel is supposed to be helping Ken.
You want me to move down further? Look, the truth is, when it comes to to the result of a Chapter 11, typically the trade creditors are most concerned about preserving a customer. Okay, there's not much concern about I shouldn't say that. There is concern about the dividend, but whether the dividend is 2 cents or 4 cents to the trade creditor isn't going to be the driving force. If you have a creditors committee with trade creditors on it, they want the opportunity to make up that money. So you are correct.
So on pre-packs and pre-negotiated, white knight or villain?
Peter, you haven't spoken in a while.
No, I think it's right. The truth is, in most situations, I think hedge funds get involved in are exactly as Ken described. If they're going to be sitting at the table with the debtor, they're going to drive the show, and they're not going to want an open-ended process. It'll be a pre-pack if it's in court at all, unless there's, unless that's simply not an option. And so I think in those situations, the trade is largely protected. I think that said, there's also a point for the trade too, where preserving a customer may not be the paramount issue. And we're working on a situation now where, for example, the trade is being difficult simply because there's another large competitor of the debtor. And so they could pack up their business and probably make nearly as much business by not preserving the customer. So I think it can cut.
It'll be short-lived, as I learned from Circuit City, when Best Buy can't come out either, but,
Yeah.
or Borders Books, or all of those. I mean, that's part of the problem. If they think there's another customer, then they...
Yeah, they may well find themselves mistaken, and it's always, I think, worse for a vendor to have fewer options. But
So now we'll go 363 sales. And Ken, you mentioned this earlier on. Is it a bad thing to do, well, let me go back to one thing. I'll ask Peter again. Peter, I mean, what's the hedge fund view of whether you should even commence a bankruptcy? I mean, I've been in a lot of things lately. Is it a last resort, or is it a desired, and when do you sort of use it as a strategy?
it's really not the desired outcome. I think it becomes part of a strategy to deal with holdouts. I mean, generally, you're going to need to get 100% to avoid it. And that gives holdouts tremendous leverage to demand a very high off-market price for their debt. And so if you get to the table and the 4 largest hedge funds are 80%, they're going to have to buy out the 20% to get it done out of court. And so I think bankruptcy very much becomes a strategy to pressure those 20% to get a deal done. I think there are other situations where you're going to want to get, you're going to look at a pre-pack basically to cram down, your junior lenders. But it's rarely, and certainly in my time in the business, very rarely been your option of first resort.
And the short bankruptcies, Ken, what's your thought about pre-pack?
Look, I complain a lot about the fact that there aren't traditional reorganizations like there used to be. But the truth is, we've done it in large part to ourselves. Chapter 11 has become so expensive that I think a lot of funds, a lot of lenders simply don't have the willingness or the patience for the 12 months, the 24-month, the 36-month Chapter 11. And those elongated cases where you place a bet that the debtor and its chief restructuring officer can fix the business and create value, a lot less people willing to take that risk. And I do understand that in terms of preserving an enterprise, which preserves jobs and preserves a customer, there is an argument to be made that a fast strike, meaning a prepackaged or prearranged case where debt is swapped for equity, a 363 sale takes place, and the company goes on its merry way, owned by a different equity group. I do see that there's merit to that, because it probably increases the likelihood that the debtor in some altered state will continue in business. I don't know what the actual success rate is in Chapter 11, or what the statistics are in terms of how many entities under the debtor's current management or CRO actually create more value in Chapter 11 than they erode. But I don't have a philosophical problem with what I'll call quickie Chapter 11s. I do have a problem with a lot of 363 sales that are the first order of business. Usually it takes 10 minutes. The first order of business in a Chapter 11, because many times we're not that enthralled with what the pre-petition marketing process might have been. The sale is being, we've seen cases literally where the 363 sale is a few weeks after the commencement of the case, and you don't even have time to dig in and figure out whether the pre-petition marketing process was good, because the debtor's counsel is telling the judge that Rome is burning, and the flames are being fanned, with petroleum.
And so we turn to that now. Do you think that's hedge fund results, ABL lender results, traditional lender results?
No, that's one of the few things I don't blame on private equity or hedge funds. I think that's the result. I think that's the result of the simple fact that Chapter 11 has become incredibly expensive, and the people with the most money at stake aren't willing anymore, to let things unfold over a long period of time. Their attitude, I think, probably is that, if we're going to create value, let's create it for ourselves. Why leave this thing in Chapter 11 and create value for the people, the bottom of the capital stack. Can't believe I just said that.
We should now say that the views expressed here are not the views of the firm and the lawyers.
We forgot that disclaimer.
Court hearings, because we get tape game. What about, Pat or Peter, what about your view of 363 sales? What role have hedge funds, private equity played, good, bad? Is it a result of their activity? Is it a result of their analysis that sometimes the business just has to be sold as opposed to reorganized and you need new management? Is this just taking advantage of the old, the bad quote loan-to-own strategy and over-lever the company? If the company performs, I make a great return. If the company doesn't perform, I own the business.
I mean, just in terms of 363 sale versus pre-pack, et cetera, I think a lot of that's actually tax-driven too. And so I don't think there would be a specific sort of hedge fund movement for one or the other. As a whole, I think a lot of it's going to be tax-driven. The tax attributes of the debtor are really going to help determine what's going to be the optimal way of restructuring here. So I think that's, but I would agree with Ken that, they're part of the issue is simply the cost of the restructuring process.
Well, is it the cost of the process, or is it the failure to perceive the value of the company by the current owners? My question is, does the process get started too late because the owners believe it's going to turn around and by that time the marketing process can't be? Is it because the owners took too much debt and now, they realize they can't dig out of the hole?
Can I say something? I happen to think that hedge funds and private equity probably have been a positive in getting...
We've turned them around.
Yeah, I'm not going to make this statement more than one time. They probably have been a positive in getting a debtor's management to realize that they're really not that smart. And they don't have the answers, and that, that there needs to be a change in the dynamics. That I do believe.
I think, sorry for your question, Gregg, just to get a little further, I think it's pretty rare that a remotely significant investor is going to be surprised. You sort of talk about they're finding out too late about the company being distressed. I don't think that happens that often anymore. Is it happening?
Well, the investors don't, but how many people here read your debt wire and everything, and a case is going down 2 years before, but then you get to the management, and the management is in denial until the very end, and then you're in a liquidation, right?
Yeah, I think quite frequently we're at the state now where hedge funds are pushing management. It's certainly, we're calling management a lot more the other way around. Saying we just got your latest numbers, according to your 3-year projections, you're going to miss covenants 4 quarters out.
So that I can't believe I'm saying this. That means that the hedge funds and the PE shops are causing management to focus on their problems a lot earlier than what would otherwise be the case, or what was.
Well, and Ken, let's talk. We talked a little bit before. Traditional lenders, the old traditional lenders, right? What did they care about? What did they look at? And when did the conversation with management first occur? Then what? We'll ask Pat.
Greg, as you said over breakfast, all they gave a damn about was what's the collateral value compared to the debt. If that's okay, you can hang yourself.
So if I have a fully performing loan and I have collateral coverage and there's no real other covenants, I don't have to look at this loan.
Well, I'm not sure that it goes that far, but as long as they got plenty of collateral coverage, I'm not sure they're sweating like many others would.
And Pat, you represent the company side. What have you found with respect to when people are buying the debt, whether it's funds or otherwise, and you start to see the debt trade? How much more active is it, and how much more does management have its spine up, so to speak, earlier on?
When the debt trades, again, you keep coming back to, usually it's trading into the hands of somebody who has a point of view, somebody that wants to put money to work. And when you think about term loan lenders and you think about people that are willing to provide liquidity to the company, they have a point of view, they have a view on management, they have a view on where they think the company should go. And yes, they act like they're large and in charge, and it can be frustrating at times, but you're by definition at that point, you're sitting down across the table from somebody. There's somebody there with a point of view about the company. They've put money to work, they've put money at risk, and they're someone you can have a conversation with, which at the end of the day is a good thing. When people support it, by the way, they're buying the debt of the company because they believe in the company. Yeah, they want to own it, but no one's buying the debt of a melting ice cube, okay? So you've got a real operating business, you got a nice company, and there's hedge funds that are buying into the debt because they want to own the company. And again, to the extent that that puts me in the position of having an option as opposed to just GE or Wells, that's a great thing.
Actually, what I'll take issue with is the melting ice cube markets. I mean, there's actually an incredibly liquid market in the melting ice cubes in traditional media, especially you see it. I mean, everyone knows that the bulk of newspapers, yellow page business. I mean, these are things where the debt's actually trading incredibly fast. And this is sort of what I talked about before. I think there are two types of players. There are the long-term players that are very much avoiding those situations. And there are the short-term players that are just trying to play on market timing, on trading volume, on small pieces of information.
Which brings me back to, Peter, that's a great point. Hedge funds, villain, white knight, are they willing to get restricted or not? Anybody that owns the debt of the company that's willing to get restricted, obviously I think is a player in the restructuring.
And those small players will never become restricted. I mean, that's
Small players are people that are just going to ride along or don't know what's going on. They won't become restricted and they want to continue to buy the debt. So I guess we'll go now to what I'll call the traditional Chapter 11 cases, to the extent they still exist. They're not a pre-pack, it's not a 363 sale, it's either going to be a reorganization or liquidation. So when I look at the list of people and you look at, well, if it's going to be a liquidation, who's the cause? Is it caused by lender positions, what I'll call the traditional bondholder at par positions, the trade creditors, shareholders, or private equity and hedge funds? Ken, any thoughts?
Depends upon the nature of the case. I mean, if the case is bondholder driven, I don't really think that the trade creditors are going to have a big influence in whether or not the company is liquidated. It will be liquidated only if the bondholders see utterly no alternative. If they don't see an option to sell the company, if they're not willing to take the equity, that'll be the only situation. I don't think trade creditors typically are pushing for a lot of liquidations.
Well, I can name one case. So leaving that side for another panel. But what's the tension between the bondholders and the trade creditors? And do you find that that tension is the same or different when you take, for example, the center bridges, the oak trees, the canyons that end up to be the bondholders not at par but at a distressed value? Does that ease the tension or not ease the tension?
I'm not sure there's a lot of. I'm not sure how much tension there is until it comes time, for example, to discuss what's going to be the nature of the recovery. The bondholders on a creditors committee are very happy to get equity, very happy to get warrants. Trade creditors don't want warrants, they don't want equity. They'll typically never be able to keep track, of the warrants, know when to exercise them. They can't keep track of how the debtor's doing. They end up in someone's vault. So there will be a tension over the nature of the recovery in Chapter 11. I'm not sure that there's a lot of tension in the case when it comes to, how to restructure and rehabilitate the debtor's business. There may be some tension on the creditors committee when it comes to things like, CURPS and KEEPs and critical vendor motions and stuff like that, but that's usually not that huge an issue.
All right, well, why don't we go then to that slide? So we get to the traditional case, and let's assume we're trying to have a restructuring. I listed a few major topics, DIP financing, KIPes and CURPS, vendor issues, since we picked on you. The critical vendor, the 503B9, and the preference actions.
Well, on 503B9, there will be a distinction because the trade creditors who are sitting on the committee may have big 503B9 claims, and they're going to want those accorded, administrative status. Even though the code says they're supposed to have administrative status, they don't always have 100% administrative status. So there'll be some distinctions on the amount and timing of payment of those claims and how they play a role in the drafting of a plan of reorganization. There also might be some significant distinctions in the payment of critical vendor claims. My assumption is that the bondholders on a creditors committee won't have quite the compassion for the payment of critical vendor claims, and probably you're going to want to see a slightly higher threshold met before they're paid.
So let's compare, let's say, a traditional lender, a bondholder at par, and an equity fund. Who do you feel more comfortable is going to waive preference actions, allow the 503b9 get paid, or critical vendors, and have a reorganization?
Well, you have to begin with the premise that, that the bondholders on a creditors committee will arrogantly assume that preferences must be pursued and can't be waived, because that's the way it is. We see plenty of cases, where lenders are getting a lien on preferences. Bondholders don't particularly care about that. Trade creditors on a committee will care a lot about that.
Pat, have you found anything or let's go to Peter. How much do you care about those trade creditor issues? Again, assuming you're not going for a liquidation, right? Liquidation makes all those, I think, big issues. But in the general sense, we are hedge fund, private equity. What's your view of those things?
Honestly, they're not big on our radar screen. I think generally, if loans are not going for liquidation, you want to squeeze the value out as little as possible. But on the other hand, they're usually much smaller money issues for us.
And Pat, negotiating asset purchase agreements, whether you're the company or the purchaser, when you're representing funds or the company, what's generally been the way they've approached those? Preference actions.
I'm glad one thing it bothers me to no end, that this issue about dip lenders getting a lien on avoidance actions or getting a lien on the proceeds. What bothers me is if someone's loaning money to the company and they can't get paid back, why wouldn't they get a lien on avoidance actions?
I tend to disagree with that.
Why? Of course you do, but okay. So I'm going to loan $100 million to the company post petition, and to the extent that I can't get repaid by regular way collateral, I'm not allowed to get a lien.
Yeah, that's exactly right. You're lending on the collateral. You don't have any idea really what the preferences are, and the unsecured creditors shouldn't have to repay your debt that you made post-petition.
Anybody that wants to loan money to a company that I'm representing can have a lien on avoidance actions.
Yeah, we would, as I said, it's not something that would take a huge amount of our time. I don't think it's a question that would necessarily rise to the top levels, but we would certainly argue for the lien taken's advice.
Yeah, but it's not a big issue for you, but 503b9s and preference actions are a real big issue for the trade creditors.
Yeah.
Sure,
I think in a way there's a mismatch in size for the most part.
And at the end, let's assume you're getting a reorganization, or Pat, at least my experience is, if you're going to be a new owner and you're in debt, you're one of those private equity, isn't it normally the case, either in the asset purchase agreement, that you pick and choose which preference and avoidance actions you waive, and that you actually want that trade there because you're now taking the business? Now, you may give them a small dividend, which puts Ken in the awkward position. Do I want a dividend, or do I want a waiver, and do I want my 503b9? Ken, have you been put in that position? Do I get the dividend, the waiver?
Look, it depends upon the level of arrogance of the bondholders that are controlling the case. Okay, in Quebecor, the dividend in Quebecor, all preferences were pursued because of a perception that screw the trade creditors. We're so big, they're going to sell us anyway. No one's going to turn down doing business with us because they're being sued on a preference. So,
which probably is true.
Yeah.
I didn't say it wasn't true. I'm just saying that.
Boy, Ken, you're really going to give up the ghost here.
I feel like I'm getting bludgeoned here.
Aren't you glad you filled in for Gary on this panel?
Absolutely.
What about differences of opinion between private equity funds with traditional DIP lenders? If they're not the lender, you see any difference about the way they see the DIP loans or anything like that? Or do you think that a DIP loan's a DIP loan, great, get financing there, leverage the company, and maybe I'm the second lien or I'm in the tranche, and it just gives me a greater opportunity in the restructuring? Pat?
From the company's point of view, the biggest problem with hedge funds as dip lenders is hedge funds don't make revolving loans. And so the one advantage that, a true ABL lender and the ability to get a revolving loan, which is what a company wants and needs at the end of the day, it's the easiest thing to do business with. It's a big advantage, and then when you're talking to people like Peter, and when you're talking to the Centerbridges of the world, and you start talking about, delayed draw term loans, I mean, these things, the hedge funds will make those loans available to the company, but at the end of the day, that's not a very workable loan sometimes. So, Peter, I'd be interested in, Peter, your views on, DIP financing and where you guys get involved with that.
I mean, I think what Pat says is absolutely right. I mean, traditionally, we don't want to be ABL lenders. It's very difficult for us to be revolving lenders. Go out on a limb, and I'll say probably less than 1% of our funds portfolio is now invested in any type of revolving debt. That said, I mean, I think especially if you're a sizable investor, or if you're in the if you're concerned about your position, I mean, I think a DIP loan is often a very attractive piece of paper to buy. You get roll-up potential, which is huge. If you look at recoveries on DIP loans, very high interest. I mean, it's one of the few places in the market where there's some yield. So I mean, I think DIP loans are very attractive to hedge funds. Hedge funds do provide DIP loans, but I think you're going to see they're not going to be daily draw DIP loans.
Do you think, you're turning back to some of the points you said, there's a lot of money out there, you guys are all looking for returns. Do you think you're going to see more funds in the next year or so making those DIP loans, because the market loans are a lot less yield, and you can still get a semi-decent recovery on a DIP loan with a short-term turnaround, and it's probably the most secure?
I mean, look at Kodak, for example. I mean, right now you actually have dueling groups of hedge funds trying to provide a new DIP facility.
The exit rate.
Yeah. Which will become theirs, yeah.
Right. Ken, why don't we go next, or anyone, on KIPES and KERPS management treatment? What do you see any difference between what I'll call the traditional lenders, bondholders, and private equity players with respect to these kind of, key executive incentive programs or KERPS? Have you seen much of a difference, or do they take a very active role in there? Peter, what's your view of when a company comes to you and says, now we're in restructuring, we're working on the restructuring, the management programs you see? Do you get much involved, or you?
We get very much involved. I mean, we believe, and I think most funds will, even more so private equity, that providing the appropriate incentives to management is one of the best ways to provide value to a company. I also think this is probably a mismatch here between Wall Street on the one hand and corporate America on the other hand. I think a lot of private equity players, hedge funds, are very comfortable with very generous employee bonus plans, employee retention plans, provided the incentives are aligned.
But you've used a key word. What are the incentives? Because I'm sure Ken's one of the questions you always get on the bank. Is this really a retention program, or is this an incentive program? So when you look at
or is this, from our perspective, or what we also run into, is this simply a handout to basically private equity employees who are working in the portfolio companies?
Right. So how do you look to incentivize people if you're, if you think at the end of the day you're going to be either an equity holder of the reorganized company? What do you look for when thinking about these KIPES and KERPS?
I mean, it's all over the map. I mean, I think it really just depends on the place of the company. I mean, sometimes they're simply, tied to the outcome of the restructuring. I think what we really like to see are tied to EBITDA. I mean, that's the gold standard for us. Are they tied to specific EBITDA metrics?
Do you really think management's taking a hike that fast?
If what?
Is management really taking a hike if they don't get the KERPS and the keeps that they want?
I honestly, I think you probably have a differentiation between my personal views and the views of the industry. And that's why I said the mismatch between sort of Wall Street and corporate America. I think because so many of the folks making the decisions on the employee plans are folks who are extraordinarily highly compensated. The numbers that they think are reasonable may not be reasonable or might be excessive.
Yeah, Ken, I think my answer would be just like trade creditors are probably going to continue to go if they don't get the dividends. The answer is probably no, but the ones that have the flexibility are the ones that are the most important, and you don't want to take the risk with the trade creditor, and you don't want to take the risk with that one employee.
There's this tug of war on the committee, because committees have changed a bit over the days. Unions are on the committees almost all the time. PBGC's on the creditors committee almost all the time. Indenture trustees are on the creditors committee almost all the time. So the composition of the committee I think makes a big difference in how the case unfolds in terms of, of retention and incentive plans. And if it's a case, and we've all seen this, you probably more than anybody just recently, we've all seen situations, where because of the nature of the membership of the creditors committee, the opposition to curbs and keeps is a little different than what it would have been if it was a traditional creditors committee of bondholders and trade creditors. Trade creditors might be a little reluctant to poke management in the nose at the same time that they're going to be visiting tomorrow, seeking a new purchase order. Unions in a case where the CBAs are being renegotiated probably isn't that shy.
Again, let me just ask you a question. You mentioned the indenture trustees sitting on the committee. Have you seen a difference in the indenture trustees' conduct now that, they always have to be directed, but if the debt is traded and it's held by the funds, do you see any difference in their conduct?
If the bonds...
Yeah, if the bonds are held the notes are held by 80% by Centerbridge and these guys, but you still have an indenture trustee, and a lot of times they're on the committee.
And all you got to do with the indenture trustee is pay his fees.
Right.
And then everything's cool. I mean, it's such a joke. It is. That's all they care about. Though.
And avoiding any risk.
Right. Just pay my fees and tell me where to show up. Yep. So look, at the end of the day, though, that the comment I just made, the joke I just made, though, it's
a joke?
It wasn't a joke, because in every case you're ever in, all the indenture trustee wants is his fees paid.
Right.
And they provide very little value, and there's nothing actually happening. It's like, at the end of the day, the hedge funds are a pain in the ass, but they want to solve your problem. They have money at risk, and they want to be part of the solution. And yes, they have a point of view, and yes, they're tough to deal with. But at the end of the day, when you represent companies that need liquidity, you need people that are willing to provide financing. You need options. And, these trade credit, it's, the trade creditor committee. Come on. Look, at the end of the day, it's like, get out of my way, let me rehab the company, and then the company comes out, you're going to still do business with the company.
Or give me really, really long terms.
Yeah.
We have about 4 or 5 minutes left. We have any questions of the panel from anyone out there? I know we've been talking for close to
an hour and a half, which is amazing. Yeah.
Which actually amazes all of us here. Anybody have any questions for anybody on the panel? Comments? I'm glad I saved that 5 minutes.
Thanks, everybody.
But I think you all get your whole hour and a half CLE. That's the really important thing, is we're in a 50-minute hour state or something like that. Thanks very much.
Thank you.